You know, people are always asking me about gold. Warren, what do you think about gold? Should I buy gold? Is gold a good investment? And I understand why they ask. The world feels uncertain. Governments are printing money. Debt levels are astronomical. And gold, well, gold has been around for thousands of years. It feels safe. It feels solid. It feels like something you can trust. But here's what I'm going to tell you today, and I hope you'll really listen. Gold is one of the worst long-term investments you can make. Not the worst. There are worse things you could do with your money, but for a long-term investor who wants to build wealth, who wants to provide for their family, who wants financial security, gold is a mistake. A costly mistake. Now, I know that's going to upset some people. The gold enthusiasts, the gold bugs as we call them, they're going to say, I don't understand. They're going to say, I'm out of touch. They're going to say, times have changed. But I'm not saying this to be provocative. I'm saying it because it's true, and because I've been studying investments for over 70 years now, and the data is absolutely clear. So let me take my time here and explain exactly why gold is such a poor investment. I'll give you the history, the numbers, the logic, and I'll compare gold to what I believe you should actually be doing with your money. The pet rock: why gold doesn't create value. Several years ago, I called gold a pet rock. And let me tell you, I got some angry letters about that. Really angry. But I wasn't trying to be insulting. I was trying to be accurate. Because when you strip away all the mystique, all the romance, all the fear-mongering, what is gold? It's a metal. It sits there. It doesn't do anything. It doesn't produce anything. It doesn't create anything. Think about this for a moment. Really think about it. If you buy an ounce of gold today, and you put it in a safe deposit box, and you come back in 10 years, what do you have? You have an ounce of gold. Same ounce. It hasn't grown. It hasn't produced income. It hasn't generated anything. It's just sitting there, looking pretty perhaps, but doing absolutely nothing. Now, let's compare that to a productive asset. Let's say instead of buying that ounce of gold, you buy stock in a good business, Coca-Cola, for example, which Berkshire has owned for decades. What happens over those 10 years? That business is working. Every single day, it's producing beverages, selling them to customers, generating profits, paying dividends. And those profits get reinvested, creating more value, generating more earnings. It's compounding. At the end of 10 years, you don't just have the stock you started with. You have all the accumulated value from 10 years of productive activity. You've received dividends. The business has grown. Its brand has strengthened. Its distribution network has expanded. It's serving more customers in more countries. That's the fundamental difference between a productive asset and an unproductive one. And it's huge. It's the difference between wealth creation and speculation. The historical record. What the numbers actually show. Now, let me give you some real numbers because I believe in facts. I believe in data. I believe in looking at what actually happened, not what people wish happened or what they fear might happen. In 1980, gold hit $850 an ounce. This was a huge spike. Everyone thought gold was going to the moon. There was high inflation. There was the Iranian hostage crisis. There was tremendous uncertainty. People were buying gold hand over fist. And what happened? Gold fell, and it kept falling. For 20 years. By the year 2000, gold was trading around $300 an ounce. That's a decline of about 65% from the peak. 2/3 of its value gone. Now, during those same 20 years, was there inflation? Yes, plenty of it. Did gold protect investors against that inflation? No, it did the opposite. It destroyed wealth. Meanwhile, and this is crucial, if you had invested in stocks during that same period, in productive businesses, you would have done extraordinarily well. The stock market went up roughly tenfold during those 2 decades. While gold investors lost 2/3 of their money, stock investors multiplied their wealth by 10 times. That's not a small difference. That's a life-changing difference. That's the difference between a comfortable retirement and struggling financially. Now, the gold bulls will say, "But Warren, what about 2000 to 2011? Gold went way up then." And they're right. Gold did rally from $300 to nearly $1,900, more than six-fold. But you know what else happened during that period? We had the tech bubble burst, we had 9/11s, we had the financial crisis. Real economic turmoil. So yes, during a period of extreme crisis, gold went up. That's what it's supposed to do, isn't it? But then what? From 2011 to 2015, gold fell again, dropping to around $1,050, lost almost half its value. And during that time, stocks recovered and went on to new highs. Businesses kept producing, kept earning, kept creating value. So gold is volatile, really volatile. Sometimes it goes up dramatically, sometimes it falls dramatically. And here's the thing, there's no reliable pattern. You can't predict it, you can't value it fundamentally. You're just guessing, hoping that fear will be greater tomorrow than it is today. The thought experiment, the cube of gold versus productive assets. Let me share with you a thought experiment I included in my 2011 shareholder letter. I think it really crystallizes the issue. Today, the world's gold stock is about 170,000 metric tons. If you melded all of that gold together, it would form a cube measuring about 68 feet on each side. Picture it fitting comfortably within a baseball infield. At $1,750 per ounce, which was roughly gold's price when I wrote this, the total value would be about $9.6 trillion. Let's call this Pile A. Now, let's create Pile B for an equal amount, $9.6 trillion. For that money, you could buy all of America's cropland, 400 million acres producing about $200 billion worth of crops annually. You could also buy 16 ExxonMobils, one of the world's most profitable companies, earning more than $40 billion per year. And after buying all of that, you'd still have about $1 trillion left over for walking around money. Now, here's my question. Can you imagine an investor with $9.6 trillion selecting Pile A over Pile B? Think about what happens over time. A century from now, those 400 million acres of farmland will have produced staggering amounts of corn, wheat, cotton, and other crops, and will continue producing that valuable bounty. The 16 ExxonMobils will have delivered trillions of dollars in dividends to their owners, and will also hold assets worth many more trillions. And the 170,000 tons of gold, it will be unchanged in size and still incapable of producing anything. You can fondle the cube, but it will not respond. I'm confident that the $9.6 trillion current valuation of Pile A will compound over the century at a rate far inferior to that achieved by Pile B. The insurance argument, why gold isn't a reliable hedge. Now, I know what many gold advocates say. They say, "Warren, you're missing the point. Gold isn't about returns. It's insurance. It's protection against inflation, against currency collapse, against government malfeasance." I understand that argument, I really do. There's some logic to it. But here's what they're missing, and it's a big thing they're missing. Gold is actually not a good inflation hedge over the long term. The data simply doesn't support it. Remember those numbers I gave you? In 1980, gold was at $850. 20 years later, it was at $300. During that time, was there inflation? Yes, significant inflation. Did gold protect you? No. It lost 2/3 of its value. A true inflation hedge maintains purchasing power. It goes up when inflation goes up, and goes down when inflation goes down. Gold doesn't do that. Gold goes up when fear goes up. That's not the same thing. If you want real inflation protection, own businesses with pricing power, businesses that can raise their prices when costs go up. Own companies like Coca-Cola, which has maintained and grown its real earnings power for over a century. Own See's Candies, which we've owned at Berkshire for 40 years, and which has consistently been able to raise prices ahead of inflation. These businesses actually protect against inflation because they produce something people want, and will continue to want, regardless of what's happening with the currency. They create value. Gold doesn't. The carrying costs, the hidden burden of gold. Ownership. Here's something else people don't think enough about. The carrying costs of gold. When you own gold, physical gold, you have to store it somewhere. You need a safe or a vault. You need security. You need insurance. All of that costs money. Real money that comes out of your pocket every year. Money that reduces your return. Compare that to owning stock in a good business. There are no carrying costs. The business maintains itself. In fact, the business might pay you dividends. So instead of paying money to hold the asset pays you to hold it. Over decades, this difference compounds dramatically. Let's say carrying costs for gold run about 1% per year, which is probably conservative if you're doing it right, with proper security and insurance. Over 30 years, that's 30% of your capital gone, just in fees. Meanwhile, a good business might be paying you dividends of 2 to 3% per year, which you can reinvest. The mathematics of this are brutal for gold investors. The valuation problem. You can't know what gold is worth. Another fundamental problem with gold, and this is a big one, is that you can't value it. There's no way to determine what it should fundamentally be worth. With a business, I can look at its earnings, its cash flows, its assets, its competitive position. I can run a discounted cash flow analysis. I can figure out, roughly, what a fair price is. Is this business worth buying at this price or not? I can make a rational decision based on analysis. But with gold, there's no fundamental value. There are no earnings to analyze, no cash flows to project, no book value to reference. Gold is worth whatever someone else will pay for it tomorrow. That's it. That's the entire valuation methodology. You know what we call that in investing? The greater fool theory. You're buying something hoping that a greater fool will come along and pay more for it later. That's not investing. That's speculation. That's gambling. And I don't like gambling. I never have. Because in gambling, you can lose. You can lose big. The psychology of gold. Fear as an investment. Strategy. Let me talk about something I've observed over my many decades in this business. The psychology of gold investing. People buy gold when they're scared, when they don't trust the government, when they don't trust the financial system, when they think everything's going to collapse. And I understand that fear. The world can be scary. There are real risks out there. But here's what I've learned in 95 years of life and 75 years of investing. Betting against America. Betting against human progress. Betting against innovation and productivity. That's always been a losing bet. Always. Without exception. The people who got rich, the people who built real wealth, they didn't do it by hoarding gold in a bunker. They did it by investing in productive assets. In businesses. In America. In progress. When you buy gold, you're essentially saying, I think things are going to get worse, not better. And that's historically been a bad bet, because things do get better. Not in a straight line, not without setbacks, but over time, they get better. And when things get better, businesses thrive. They produce more, earn more, become more valuable. Gold just sits there, same as always. The opportunity cost, what you're giving up. Let me give you a specific example of opportunity cost. What you give up by choosing gold over productive assets. If you'd invested $10,000 in gold in 1980 and held it until today, you'd have about $23,000. You a little more than doubled your money over 44 years. That's roughly a 2% annual return. Now, if you'd invested that same $10,000 in the S&P 500 in 1980, just a basic index fund tracking American businesses, you'd have about $1.2 million today. Let me repeat those numbers because they're important. Gold would have given you $23,000. Stocks would have given you $1.2 million. That's not a small difference. That's not a rounding error. That's a life-changing difference. That's the difference between a comfortable retirement and struggling to make ends meet. And that's the opportunity cost of gold. That's what you give up when you choose a non-productive asset over productive ones. That's the real cost of fear-driven investing. The tax treatment, another hidden cost. Here's something else people often overlook: the tax treatment of gold. When you sell gold at a profit, it's taxed as a collectible at 28% in the United States. That's higher than the long-term capital gains rate for stocks, which is typically 15% or 20% depending on your income. So even when gold does go up, you're paying more in taxes when you sell. That eats into your returns. Meanwhile, with the stocks, you get the lower capital gains rate. And if you hold forever, like I tend to do, you never pay the capital gains tax at all. You just keep compounding, tax deferred. These tax differences might seem small, but over decades they compound into very significant numbers. The liquidity myth: gold isn't as liquid. As you think, people often say gold is liquid. You can always sell it. And that's true, in theory. But in practice, if you own physical gold, bars, coins, you have to find a buyer, get it appraised, pay transaction costs. It's not like selling a stock where you just click a button and it's done instantly at the current market price. Gold takes time, it takes effort, it costs money. And if you're in a hurry, you might have to accept a price well below the spot market price. So even the supposed advantages of gold, like being real, tangible, liquid, they come with hidden costs, and those costs add up. When gold makes sense, the 5% exception. Now, let me be fair here. I don't want to be accused of being completely dogmatic. Are there times when owning some gold makes sense? Yes, I think there are. During severe crises, hyperinflation, currency collapse, war, total economic breakdown, gold can preserve purchasing power. In those extreme situations, gold can be valuable to own. But those situations are rare, really rare, and they're temporary. Most of the time, most of your investing lifetime, you're not in such a crisis. You're in normal times or even good times. And in those times, gold significantly underperforms productive assets. So maybe, you keep 5% of your portfolio in gold as insurance against the truly catastrophic. I can understand that reasoning, but 20%, 50%, 100%? That's not insurance, that's speculation. That's fear driving your investment decisions. And fear is a terrible investment advisor. It makes you do stupid things, costly things. What you should do. Instead, the case for productive assets. So, if not gold, then what? What should you be doing with your money? My answer is simple. Invest in productive assets. Own good businesses. Look for companies with strong competitive advantages. Wide moats, as I like to say. Companies with pricing power, with brands that customers love, with economics that allow them to earn high returns on capital. Companies like Coca-Cola, which we've owned at Berkshire since 1988. Every day, people around the world exchange a little bit of their labor for a Coca-Cola. That happens regardless of what the currency is, regardless of inflation, regardless of economic conditions. People want the product. Or American Express, which has built a payment network and a brand that creates tremendous value for its customers and shareholders alike. Or See's Candies, which we bought for $25 million 40 years ago, and which has since generated $1.65 billion in earnings for us, and it continues to grow. These businesses work for you. They compound. They create value. They generate earnings and dividends that you can reinvest to create even more wealth. That's how you build real, lasting wealth. Not by buying a metal and hoping someone pays more for it someday. The compounding power. The eighth wonder of the world. Einstein allegedly called compound interest the eighth wonder of the world. Whether he actually said it or not, the principle is profoundly true. When you own productive assets, you can compound your returns over time. You earn returns, you reinvest those returns, and then you earn returns on your returns. It's a snowball rolling down a hill, getting bigger and bigger. But compounding only works with assets that produce something. An ounce of gold today is an ounce of gold in 10 years. Same ounce. No compounding. It doesn't grow, doesn't produce, doesn't create anything new. A share of stock in a good business, however, represents a piece of a living, breathing, productive enterprise. That business is working every day, generating earnings, increasing its value, and those earnings compound. Over decades, the power of this compounding is extraordinary. It's the difference between modest wealth and extraordinary wealth. It's the difference between financial security and financial independence. And you can't get there with gold. The mathematics simply don't allow it. The social compact, investing in human progress. Let me talk about something a bit broader for a moment. When you invest in productive businesses, you're not just helping yourself. You're participating in human progress. You're allocating capital to enterprises that create jobs, that produce goods and services people want, that drive innovation and economic growth. At Berkshire, we own BNSF Railway, which moves 15% of all the freight in America. We're investing billions of dollars in maintaining and improving that infrastructure, private money, not government money, because it's needed, and because if we do it right, we'll earn appropriate returns. We own Mid-American Energy, which provides electricity to millions of Americans. We're investing billions in wind and solar energy, expanding capacity, improving reliability. These investments serve society. They make life better for millions of people. And in doing so, they create value for shareholders. Gold doesn't do any of that. Gold just sits there. It doesn't employ anyone, doesn't produce anything, doesn't make anyone's life better. It's purely extractive, trying to get wealth from price appreciation without creating any value. I prefer investments that create value, that contribute something, that make the world a little better while also generating returns for shareholders. That feels right to me. The modern portfolio. Theory error. Gold as diversification. Some people argue that gold provides diversification because it's not correlated with stocks. Sometimes gold goes up when stocks go down, they say, so having some gold reduces your portfolio volatility. There's a grain of truth to this. Gold does sometimes move differently than stocks. But diversification should be about owning different productive assets, not about owning something that produces nothing. If you want diversification, own stocks and bonds. Own real estate. Own businesses in different industries, different geographies. But all of those should be productive assets. Things that generate income, create value, produce something. Gold doesn't fit that definition. Calling it diversification is generous. It's more like portfolio drag, something that weighs down your overall returns over time. Cheat, the guru problem. Conflicts of interest in gold promotion. Seats. Let me mention something that might upset some people, but it needs to be said. The gold market is full of promoters who have a vested interest in you buying gold. There are people who are always predicting doom, currency collapse, hyperinflation, the end of the world, and their solution is always the same. Buy gold, buy more gold, buy all the gold you can. Now, some of these people genuinely believe this. They're sincere, if misguided, but others are just trying to sell you gold. They profit when you buy. That's a conflict of interest, and it's a big one. When someone's telling you that gold is the answer to everything, ask yourself, how are they making money? Are they compensated based on gold sales? Do they own gold mining companies? Do they sell gold coins? If the answer is yes, then take their advice with a very large grain of salt. They're not giving you objective financial advice, they're selling you something. Charlie Munger's wisdom. The big money is in the waiting. My partner, Charlie Munger, used to say, God, I miss him. The big money is not in the buying and selling, but in the waiting. He was talking about patience, about holding good assets for a long time, about letting compounding work its magic. But here's the thing. That only works with productive assets. If you're waiting with gold, you're not compounding anything. You're just waiting, hoping someone will pay more someday. But if you're waiting with stocks, with good businesses, they're compounding the whole time, growing, creating value, generating earnings, paying dividends. That's the difference. That's why I love businesses and don't love gold. The American bet, the best wager you can make. Over my lifetime, and I'm talking about more than 9 decades now, I've seen this country go through depressions, recessions, wars, crises, periods of tremendous uncertainty. And every single time, the bet on America has paid off. American businesses have been extraordinary wealth creators. They've innovated, they've adapted, they've overcome challenges, they've thrived. And the people who own shares in those businesses have built tremendous wealth. The people who bet against America, who hoarded gold expecting collapse, who let fear drive their decisions, they've consistently been wrong, and it's cost them dearly. I believe this will continue. I believe American businesses will keep innovating, keep producing, keep creating value. I believe the next 100 years will be better than the last 100 years. And if you believe that, if you believe in human progress and American enterprise, then you should be investing in productive businesses, not in gold. Conclusion: choose creation over fear. So, here's my conclusion after all these years, after all these investments, after building Berkshire Hathaway into what it is today. Gold is speculation, not investment. It's betting on fear instead of betting on progress. It's hoping for higher prices without any underlying value creation. It's paying carrying costs for an asset that produces nothing. I understand the emotional appeal. I understand why people buy gold when they're scared. But understanding it doesn't make it right. Doesn't make it smart. Doesn't make it good investment policy. If you want to build wealth, real lasting wealth, invest in productive assets. Own businesses with strong competitive positions. Companies with pricing power and high returns on capital. Enterprises that create value every single day. Let them compound. Be patient. Think long term. That's how wealth is built. Don't let the gold bugs fool you. Don't let fear drive your decisions. Don't chase shiny object. Invest in productivity. Invest in progress. Invest in businesses. That's the path to financial success. It's worked for me for 75 years. It's worked for countless other investors. And I believe it will continue to work for the foreseeable future. Now, I know after saying all this, people still have questions. So let me address some of the most common ones I hear. But Warren, what about the 1970s? Didn't gold massively outperform stocks then? Yes, gold did well in the 1970s. From 1971 to 1980, gold went from $35 to $850, a spectacular run. But let's put that in context. First, that was coming off an artificially low price. Gold had been fixed at $35 by government decree for decades. When that peg was removed, naturally there was a correction upwards. Second, even during that decade, if you'd bought the S&P 500 at the start of 1970 and held through all the turmoil, the oil shocks, Watergate, stagflation, everything, you still would have roughly doubled your money by 1980, including dividends. But here's the key. What happened next? From 1980 to 2000, stocks went up tenfold, while gold lost 2/3 of its value. So even if you timed it perfectly and bought gold in 1971, held it to the 1980 peak, and then switched to stocks, you still would have done far better just owning stocks the whole time. Cherry-picking the one decade when gold did well ignores the 5 decades when it didn't. What about central banks? They're buying gold. Doesn't that tell you something? Central banks do hold gold, that's true. And some have been buying more lately. But let me point something out. Central banks aren't investment managers trying to maximize returns. They're institutions managing national reserves with very different objectives. Political objectives, strategic objectives. They hold gold as part of their foreign exchange reserves, alongside dollars, euros, other currencies. It's about diversification of sovereign holdings, not about investment returns. And frankly, central banks don't have a great track record of investment decisions. They're not Warren Buffett. They're not trying to compound wealth. They're trying to manage currencies and geopolitical relationships. Just because a central bank does something doesn't mean it's a smart move for individual investors like you and me. What if there's a complete collapse of the financial system? This is the doomsday scenario people always bring up. And look, I can't tell you it's impossible. Anything's possible. But let's think this through. If there's a complete collapse of the financial system, I'm talking total breakdown, Mad Max scenario, what good is your gold going to do you? You think you're going to trade gold bars for food, for medical care, for security? In a true collapse scenario, what matters is food, water, shelter, community, skills, not shiny metal in your safe deposit box. And if we're not talking about complete collapse, if we're talking about severe recession or even depression, well, we've had those before. We had one in the 1930s, we had one in 2008 to 2009. And you know what? The productive assets, the businesses that made things people needed, they survived, they recovered, they thrived. Coca-Cola made it through the Great Depression. People still wanted their Coke. Good businesses with real products and real customers, they persist. So the collapse scenario that makes gold valuable but doesn't make everything else worthless, that's a very narrow window. And betting your financial future on that narrow scenario doesn't make sense to me. What about Bitcoin and cryptocurrency? Isn't that even worse than gold? Oh boy, now you're getting me started on a whole other topic. But yes, since you asked, cryptocurrency has all the problems of gold, plus more. At least gold has been around for thousands of years. At least it has some industrial uses, some aesthetic value. At least it's tangible. You can hold it in your hand. Cryptocurrency is nothing. It's code. It produces nothing. It pays no dividends. It has no industrial use. Its value is entirely based on the belief that someone else will pay more for it later. That's not just the greater fool theory. That's the greater fool theory on steroids. And the energy consumption, the environmental damage from all that computing power to maintain these blockchains, it's staggering. All that resource consumption for something that creates no value, produces nothing useful. At least when a steel mill uses energy, you get steel at the end. Something real, something useful. With crypto, you get what? A ledger entry? I stay away from things I don't understand. And I definitely stay away from things that produce nothing and consume massive resources in the process. The asset allocation. Question: so what should my portfolio look like? People often ask me, Warren, what percentage of my portfolio should be in stocks versus bonds versus other assets? And my answer depends on your situation, your age, your financial position, your needs. But here's my general philosophy. If you're young, if you have decades ahead of you, if you can handle volatility, you should be almost entirely in stocks. Good businesses, productive assets. Let them compound over time. As you get older, as you need more certainty, as you're living off your portfolio rather than adding to it, then yes, shift some money into bonds. High-quality bonds, they produce income. They're more predictable. But nowhere in that equation is gold. Not for young investors, not for old investors. There's just no place where gold makes sense as a core holding. Maybe, you keep a tiny percentage as disaster insurance if it makes you sleep better. But we're talking 2 to 5% maximum, not a meaningful allocation. The rest should be in assets that work for you, that produce income, that create value. The timing fallacy, but I'll buy low and sell high. Some people tell me, Warren, you're right that gold doesn't compound. But I'm going to trade it. Buy when it's low, sell when it's high, make money on the swings. Good luck with that. You know how many people I've met over 75 years who could consistently time the market? None. Zero. Not one. Oh, people get lucky sometimes. They call a top, they call a bottom. But do it consistently? For decades? Impossible. And with gold, it's even harder because there's no fundamental value to anchor your decisions. With stocks, at least you can analyze earnings, look at valuations, make educated judgments. With gold, you're just guessing about fear and sentiment. That's not investing. That's not even informed speculation. That's just gambling. And the house usually wins. The inflation debate. Let's look at real data. Let me give you some more specific inflation data because this is so important. From 1980 to 2020, 40 years, inflation in the United States averaged about 2.9% per year. The dollar lost roughly 60% of its purchasing power. During that same period, gold went from $850 to about $1,900. Sounds good, right? More than doubled. But wait, adjusted for inflation, that $850 in 1980 is equivalent to about $2,800 in 2020 dollars. So gold, even at $1,900, was still below its inflation-adjusted 1980 peak. In other words, if you bought at the 1980 peak and held for 40 years, you lost purchasing power. Gold failed as an inflation hedge. Meanwhile, stocks during that same period went from about 800 on the Dow to about 30,000. And that's not even counting dividends, which would have added enormously to your returns. Adjusted for inflation, not adjusted for inflation, any way you slice it, stocks demolished gold. The behavioral challenge. Why people still buy gold. So why, given all this evidence, do people still buy gold? Why are there still gold bugs? Still people convinced that gold is the answer?